It's yet another week, and it's the Breed and Grow Financial Talk Point. Your host, as always, Ila Boyson Mayengo. And still with me, I have a finance guru, Mr. Lugorobi Francis Kabinoli, the Chief Finance Officer, Breed and Grow Business Home Limited. Welcome, Mr. Lugorobi.
Thank you.
Always an honor having you on this show to share the knowledge that you have with us. Today we're talking loan, we're talking debt, we're talking credit. The world over, it's a discussion that has caused divided minds and divided opinion on whether it is actually a go-to option or it's a run-away from option. There are very many superstitious beliefs around the subject and so many conspiracy theories about so many businesses and their failure, especially in relation to the subject of loans, credit, and debt. We're going to dig deeper into the subject and try to understand what that means to you and to your business. Don't go away, we're coming back soon. Once again, welcome to the Breed and Grow Financial Talk Point. Ila Wilson, my host, with the finance guru, Mr. Lugorobi Francis Kabinoli. We're talking debt, we're talking loan, we're talking credit. Mr. Lugorobi, speaking in the Ugandan perspective, what is a loan?
A loan given a Ugandan blend is borrowing something of value.
Okay.
Actually, not only a Ugandan blend, but international blend. A loan is when you borrow something of value, but most Ugandans would look at a loan as borrowing money.
Okay.
Yeah, because most of us borrow money, though other people can borrow other items of value. So whenever an individual, an organization, a company, or even government borrows something of value, usually with interest attached to that borrowing, we call that a loan.
Okay. It might not necessarily be money.
It doesn't have to be money.
Okay.
Okay, some loans are not money.
Okay.
Yeah.
Interesting.
Some loans are items which you can translate into money.
Okay.
Yeah. For example, if I'm an individual and I start a business and I want to run my business, I need some items, machinery, and plant. So I go to another person who has that item, and then I get it from them. I borrow it from them, and I set terms of payment between me and the lender. That becomes a loan.
In other words, a credit purchase would translate into a loan.
Yes, it can translate into a loan.
Okay.
The best example I can give you is many people are in Uganda. Many people are into purchase of taxis. We call them taxis, minibuses, which transport people.
Call them matatus.
Matatus, yeah. Most of them usually don't have money. Most ordinary Ugandans don't have the cash to buy them. So they go to a seller.
Okay.
They go to a vehicle bond,
Okay.
and then they get the vehicle, and they pay maybe an amount which may be equivalent to 20% of the amount required, and they get the vehicle or the minibus, and they pay it over time.
Okay.
So that's a loan. It's a vehicle loan. Yeah, but this person has not borrowed money from a bank to buy the vehicle, but this person has gone and gotten the actual item of value, which is the vehicle, and has gotten it from the lender, whom is going to pay over a period of time with interest.
So that kind of remains, is it what we call hire purchase?
Yeah.
Okay.
We call it hire purchase. Yeah.
So hire purchase would translate into a loan.
It's a loan.
Okay.
It's a type of loan.
Very interesting here. A loan is not only the monetary acquisition of a period of time, but even an asset acquisition over time. Oh, interesting. So when does a loan, in the Ugandan legal setting, when does a loan materialize to have been taken or given? When do we say you've taken a loan? What must be in place to say that you've taken a loan?
for someone to be liable to pay back a loan,
Okay.
or for someone to be in a position of having a loan, is when that money has crossed hands, or when that item of value has crossed hands. When it comes to, there are certain different types of loans that I think we'll talk about later, but then if it's a gentleman's understanding and I'm borrowing money from you, I'm borrowing 1 million Uganda shillings from you, the moment we agree on the terms of that loan, the terms meaning that I'm giving 1 million Uganda shillings, and you're returning 1,100,000 Uganda shillings at the end of the month for the term, and then the moment you get the money and hand it over to me, at that material moment, that's when I have a loan.
Okay.
But when it comes to the bank, banks sometimes give you can even sign a loan contract, but they're given a period of grace whereby you can void the agreement, and the bank takes back its money. So for the bank to count a loan, if you count the loan as a loan after that period of grace, maybe 7 days, or 14 days, which is usually 2 weeks.
Okay. So whether or not there is pen to paper, I've taken it's considered a loan, because I'm trying to figure out a situation whereby I come to, for instance, like you give an example, I take 1 million Uganda shillings, I promise to return 1,100,000 Uganda shillings, but then there's nothing written, there's no witnesses. Legally, is that a loan? Can I go to court and try to lay claim, or can Francis go to court and lay claim that he lent me money and I failed to pay?
Of course, loans like any other contractual transactions, they are governed by the contract law, the law of contract.
Okay.
Yeah, a law of contract doesn't have to involve you putting pen to paper. Not always should there be a witness. Just like when you go to a shop to buy an item, there is only the shop attendant, and they can sell you something. You give them money, and they give you the item. So a transaction has happened, but nothing has been written down. So even with the loan, especially the informal ones and personal ones, you can have a loan on a gentleman's understanding, and it's legally binding. Yeah. Only that when it comes to being enforced, if there is a conflict between the two of us, if there is lack of documentation and lack of witnesses, one of us, the parties involved, will have a problem proving that actually I lent you money, or at which terms did I lend you money. It gets easy. So it's very important to have witnesses, not only witnesses, but also to put pen to paper, because in that way you have proof to fall back on in case there is a disagreement between the parties involved.
Actually, then you push me to the next very important question of, you spoke of personal loans, and you spoke of business loans, and you spoke of bank loans.
There are so many.
It gives me it insinuates different types of loans. Could it be the truth that there are very different types of loans?
Yeah, people actually think that it's only banks which give loans, which issue out loans. Yeah, but there are different types of loans. There are individual loans to start with. Many times back down in the villages or in trading centers and in our homes and all that, in our communities, we need products and services. And we don't have the money now, but we expect to get the money in the future. Or we expect whatever we're going to get to generate the money to pay back. So what we do is we run, sometimes we're not bankable, or we're not banked individuals. We don't have any bank accounts, we don't have mobile money accounts or things like that. So what we do, we run to the nearest relatives or friends who may have that money, and we request for a loan. And many times it's a soft loan. So we come to another type of loan, what we call a soft loan. Soft loan is on friendly terms. It has a long period of grace. It has sometimes it has no interest, or it has so very low interest rates, which are below even the market rates.
What they usually call peppercorn interest.
Yeah. Very, very low interest. So that's the type of loan we start with. Most people start with individuals. Even small businesses, by the way, and micro businesses, they run to those loans. Yeah. So those are personal loans from individuals, and they usually sometimes in loans between friends, they don't even have paperwork, and there are no witnesses. Yeah. Because these people trust each other, and their word is their bond many times. Then usually from that stage, there's another type of loan people go to. People go to financial, quasi-financial institutions.
Okay.
Yeah.
Quasi-financial
institutions. I call them quasi because they don't reach the stage of financial institutions.
Okay.
These people go to, they have, in my lingo, we call it Vivina, especially ladies. They have groups, ladies groups and ladies groups in villages, and these groups usually they save money. And these groups
community-based organizations.
Yeah.
Kind of like?
Yeah. Some of them, they're not even registered. They're not even registered. They don't even that level.
Nigina kind of thing.
Yeah, they call it Nigina. Yeah. Okay. You find a group of friends, they do they
cash rounds.
Cash rounds, yeah. They have cash rounds, but they save this money, and this money can be borrowed. Okay. This money can be borrowed. So they usually tend to go to those. And they, for them, they usually charge an interest rate which is slightly higher than even the market rates. They will charge maybe 5% per month or 4% per month, something like that. Yeah. And even these ones, many times the collateral is not, or the security is not in form of standard security, but sometimes they get their friends who are part of the group who will use their very cash savings as security for their friend who's borrowing the money. Yeah. Then from that point on, usually when businesses get bigger, people tend to borrow, or even individuals are in a better financial position, they borrow from SACCOs. Now these SACCOs are more savings and credit organizations. They're usually more organized and they are registered in government and local government. So these SACCOs, they have usually interest rates of maybe 3%, 4%, and this
per month.
Per month.
And they run on membership as well.
They run on membership. You must have a member. You must be a member, and then you should. When you're getting the interest, when you're getting the loan, there is you sign an agreement. It's quite formal, and usually they require collateral many times. Yeah. So with SACCOs, that's another the SACCO loans. What we call SACCO loans. And when a SACCO gets bigger, it's usually upgraded to a microfinance.
Savings and credit cooperatives.
Yeah.
Right? SACCOs.
Yeah.
Okay.
Usually when they get bigger, they get into microfinances. And then of course the paperwork. Now in all these stages the paperwork keeps increasing. And many times the interest keeps going down. Okay. Yes, usually if you are borrowing money from a SACCO at 5%, you'll be borrowing at 3% from microfinance, or even 2.5%, or 2% even from microfinance. Yeah. Okay. Yeah. Then you can also there are loans borrowed from MDIs, micro deposit taking institutions. These are like commercial banks but at a lower level. Okay. But even then they have almost the same paperwork as commercial banks, only that their paperwork is a little bit, you can get a loan in a shorter period of time, and the paperwork is not as rigorous as the commercial banks. Yeah. But still the interest rates are higher than the commercial banks. Then the higher end is the commercial bank. Okay. Where individuals, organizations, companies can borrow money. Even government borrows money from commercial banks, by the way. Okay. Yeah. Yeah. And by the talking about government, there are even loans whereby government borrows money. Government can even borrow money from individuals. Okay. Through last time we were talking about shares. We were talking about shares. Government issues bonds and treasury bills. Yes. Yeah. When funds raise money. So when government wants to borrow money from me, it will come to me and sell me a bill. Okay. A treasury bill or a bond. Okay. And when I buy the treasury bill or bond, government will use I'll give it money, and it will have borrowed money from me because it will pay it back. For a treasury bill, it will pay it back within a year. Okay. Yeah, with interest. Then with a bond, it's over several years, up to 10 years. Yeah. Okay. Yeah. So even government can borrow money. Yeah. So there are different types of loans.
Various places we can go to access these facilities called loans. Question is still. The question still lingers, are these facilities demons or angels to you or your business? We're talking loans, we're talking credit, we're talking debt. Coming back in a short while, don't go away. Welcome back from that commercial break. It's the Breed and Grow Financial Talk Point. Your host Ilag Wilson Mayengo, together with a finance guru, Mr. Francis Ngologi Kabiruli. We're talking loans, credit, and debt. In the previous segment, we looked at the various places where one can go to access a loan facility. And we are yet to answer the question whether these loans are actually demons or angels to you as a person and stroke all your business. Mr. Lugolobi, at a point where you talked about accessing loan facilities from SACCOs and from MDIs and from commercial banks, you talked of a word, or you introduced the word collateral.
Yeah.
Collateral. What is collateral in this loan arrangement?
Yeah, in the loan arrangement, collateral is security,
Okay.
or it's a guarantee on part of the person receiving the loan that they're going to pay back the loan
Okay.
to the person who is issuing, or the institution issuing the loan.
Mm-hmm.
Many times you get money from a lender, but this lender wants peace of mind that even if you fail to pay back the loan, they can have a legal claim to something valuable
Okay.
to help them get back the money loaned to you, plus the interest which was due from the loaning process.
Okay.
Yeah, so that legal claim the lender has on something of value you've staked out for them,
Mm-hmm.
that this person can take it over in case you fail to pay, is what we call collateral.
For example, if I went to access a loan facility,
Yeah.
they usually ask whether you have a land title,
Yeah.
you have a
Logbook.
logbook for a vehicle,
You have
you have an agreement for a chibanja.
agreement. Yeah.
Yeah.
You have you have an
Receipts for
yeah.
products like tables and what assets and such like, yeah.
Business assets. Yeah.
Okay.
Mm. Or even if it's an individual loan, they'll look at your home, they'll look at your domestic, your home property,
Mm-hmm.
television sets, fridges, cookers, things which they are movable chattels, no property, but then they hold some value, which this person can take claim over in case you fail to pay back the loan.
Must collateral be the equivalent of the money taken plus the interest accrued?
Collateral many times is more than the value of those two. Is more than the value of the money borrowed plus the interest.
Okay.
Let me give you an example. Many times when you're getting a loan from the bank would want collateral which is 2 times as much as the loan you are accessing. Yeah.
Okay.
Say for example, you want a loan of 100 millions, they want collateral which is 200 millions.
Okay.
Yeah. So that when you combine the interest plus the interest on the loan plus the loan, the collateral covers about 75%
Okay.
of what the collateral is what you borrowed is 75% of collateral. Actually, yeah.
Rings a bell. I have a colleague actually that once shared with me a very interesting scenario they experienced at the bank where they went to access a loan facility and they expected, or the value they knew for their property was much higher than what the value that the bank told them it was. And they told this colleague of mine that the bank's value is what they call the FSV, forced sale value.
Yeah, you're right.
And we couldn't understand because then I was also literate about this subject.
Yeah, these are you're right. These are financial institutions, not only banks. When they're considering the value of the collateral of something you've staked, just in case you fail to pay the loan, this item has different values. We have what we call the market value. That means that's the amount of money these items of the like are being sold at
Averagely
in the market. Then we have what we call the replacement cost.
Okay.
Yeah, replacement value is the value of the collateral it's the amount of money you would need to replace that item.
To put that item into place
at that very time.
Okay.
Not the amount of money you use to build a house or to buy a piece of land, but the amount of money you need to buy the very house or piece of land, or to build the very house at that moment in time.
Okay.
Then we have what we call the forced sale value.
Okay.
Forced sale value, the way as you hear the word forced sale, is that many times when you're selling something and you want quick money for that item, you don't have enough time to advertise this item. You don't have enough time to wait for the right buyer. You may have to sell it at the lowest amount, which is way below the market value and the replacement cost. Sometimes even below the amount of money you injected in to get that asset, even if you reduce the depreciation of the asset. So what happens is that banks use the forced sale value because in event that you fail to pay back the loan, the banks would want to get back their money as fast as possible. So they may not be able to sell
at
the
market
collateral at market value,
Okay.
or using the other cost and valuation
Replacement,
variables, yeah.
historical value, okay.
So they end up selling the item on it's a quick sale. So it's being a quick sale, they will sell it at usually below the actual market value of the cost.
Two things at play. One is now we're talking collateral value. Yeah. The other point you talked about in the previous segment was the interest.
The interest, yeah.
Question. As a borrower, do I usually have a window for bargain on these two? For example, I might feel that my asset is being unfairly valued. I might feel that my rates are exorbitantly high. Do I have a window for bargain?
You have a window for bargain, especially if you are a large borrower. Yeah, many times when you're a small borrower, the rates, the interest is fixed, and then the collateral and your room for bargaining is your bargaining power is limited. But the more you advance in the amounts you're borrowing, there's room for example, if I'm borrowing 10 millions, 10 millions and below, I may find it hard to bargain on the valuation given by usually the value I give. The value is actually many times are given to us by financial institutions if you're borrowing. But if someone gives you a bad valuation, then you can challenge it and seek for a second opinion.
Okay.
Yeah, so that you get a better valuation, because someone can give you a for sale value which is almost half of your actual value.
Even way half sometimes.
Way below half. Yeah. So you can challenge it, and you can seek a second opinion, especially if you're borrowing heavy amounts or large amounts. And even with interest, it's interesting that when you're being charged interest, most borrowers don't know that interest rates are not fixed.
Okay.
Yeah. Many times you want money, and then they tell you we'll be giving you a reducing balance rate of 30% or 35% or 25%, and you think it's set in stone, but it's not. You can sit down and with your loan officer and you can negotiate the rate. And sometimes even when you fail with the loan officer, you go to the manager. The manager can give you a better rate. Especially when you're being a continuous good client, loans client, or when you are getting a large amount of money. Yeah, these guys may not want to give away, whichever institution is lending out the money may not want to lose your business. So they are many times they are willing to haggle with you over how much interest they're going to charge you.
Interesting. It is actually true that one can go to our financial credit organization or institution and bargain out their interest, and at the same time bargain out their valuation. Very interesting points to learn here. Mr. Rugolobi, like I said in the introduction to this show, there are various superstitious to some extent, because the people who take it to a cultural level, that loans are actually demons.
They curse.
They're curse. They are demons waiting to devour all your financial being as an individual and as everything you've ever put into place, call it a business. To what extent do you think this kind of sentiment could be true?
This sentiment is not true, but it has a bearing on the perception people have picked about, especially our African-Uganda loans. Because our loans are issued at very high interest compared to the global loans market. Our interests are usually 4 times or even 6 times or 10 times higher than what's issued elsewhere, for example, in the Western world or in the Arab world. So, because our loan interests are so high, and many individuals find it very hard to pay back the loans plus the interest. The interest is so high. So, for example, an individual may have a business, a small business, and this business may be having a return on investment, or maybe turning around a profit of 20% of the money capital invested. Yeah, for example, I invest 100 millions in or 10 millions in a business, and every year I get a profit
Of 20 million.
of 2 million,
2 million, yes.
out of the 10 millions I invested. So my return on investment is 20% in that case. But then you'll find that I may want to expand this business, and I go out to get a loan. When I go out to get a loan, I'll get a loan at an interest rate of, maybe I want to get another 10 millions in loans to expand my business. And if I'm to pay at an interest rate of 24% in a year, that means that the interest rate is way higher, which is very common in Uganda, by the way. Is higher than my return on investment. That means that in order for me to pay back this loan, I'm going to dig further into even the capital of the business to pay back the loan, and I'll end up at a disadvantage, and my business may end up failing because
sounds extremely dangerous.
It's dangerous. So because of the high interest rates attached to loans, and then the other factor being that many individuals don't have good borrowing habits. When we borrow money for a particular reason, for buying more stock, for buying machinery, the first thing we do is to use some of the money to buy household items. You buy a new flat screen, you go out with friends and you booze off a million or two, and you end up, if you borrow 10 millions, you end up with only 8 millions to work on the intended purpose. So because of that may be the reason why you even the 8 million, they don't do what the 10 million is supposed to do. So you won't bring out the productivity you expected, and you fail to pay back the loan. And you many times you think it's a curse because of even that reason.
And of course, to make matters worse, the 8 million that has been invested in the business eventually also falls in the hands of extremely poor business management and business practices.
Wow. And of course, there's something like which I've talked about, which is business planning. Many times we go into loans when you haven't planned.
Okay.
Yeah, that's the first step into failing, to pay back the loan. Because we just have an instinct, we have a dream, we wake up in the morning and we follow our dream, our insinuation, our expectation, our desires, and we want to achieve that by using other people's money.
And the talk is common: follow your dream, follow your heart, follow
the instinct. Yeah. So many times, what you tell people in Bread and Grow Business Home is that before you borrow money, you take on a loan as an individual, as a family, as an organization, as a micro business, some small, medium, even a large company. Sit down with yourself. Think about the reasons why you're borrowing. Think about other alternatives. This is a planning process where you can get this money. Think about even cheaper ways you can get this money, which may not be even debt, maybe equity from somewhere else. Think about the different lenders who can lend you the money. Think about where you're going to put that money. Think about the interest rates which are available and how much you're going to get from the investment. Look at the projected investment return, and don't overestimate it. Be reasonable about it. Actually, be very prudent about it. Have low expectations of the returns, and if those low expectations of the returns on investment can pay back the loan interest and the loan loan premiums and the interest very well, then go out and get a loan. Yeah. And but if you can't pay back this loan, look at even the loan repayment period. Look at your business properly. Look at the manpower you have in the business. Can this manpower handle this loan? You want to have a client who borrowed close to $1 billion Uganda shillings, and they put it in a company. It was a company which was grossing over 1 billion Uganda shillings every year, and they borrowed 1 billion Uganda shillings. And the manpower which was going to handle the money was not adequately prepared to handle that money. So in a couple of years, this company was closing down, and the owner of the company would have thought maybe that it's because the company, there's a curse in loans, but it wasn't a curse. It's the people who are handling the money. So even look at the manpower, the human resource which is going to handle this financial resource. Can these guys handle this amount of money? Do they have enough training? So that's why even with some loans, people go out and get training. Or even, there's some institutions, before they issue with the loan, they first train you on how you're going to use the money you're going to borrow from them.
Bringing to the point I want to put out across that it actually seems very important for one to consider consulting or seeking the expertise of a financial personnel in assessing their capability of accessing the facility at a given time. I guess timing is also a very important point to note.
Yeah. Timing is very important. There are people who seek out to go for loans when they're just starting a business. Yeah, they're starting a business and they go out to seek a loan. And many times the types of business that they're starting are high-risk businesses. For goodness sake, it's very hard staking a business assets. The few business assets you have as you're starting a business on a loan, as collateral on a loan, when it's a high-risk startup, because the risks of failing are so high, and you're using debt to inject money into this business to start.
Hold it there, Mr. Lugolo. We're coming back to discuss more about loans. In fact, the question as we come back is, who and when should one think of accessing a loan facility? Don't go away, we shall be coming back soon. Welcome back. It's the Breed and Grow Financial Talk Point, and we're talking loans, we're talking credit, we're talking debt, personal credit, business debt, business credit. In the previous segment, we looked at a number of things, among which was whether a loan is actually a curse or a blessing to your business, and why the majority think it's actually a curse, especially in the African, to be specific, the Ugandan setting. Mr. Lugolobi, at the time when we cut off, you were starting on a very interesting subject of what, when, who of the loan, of the decision to access a loan facility. And I want to put it now out this way. I want to phrase the question this way. What should someone consider or look at or make sure is in place, before they make that decision to go and access a credit or a loan facility?
And thank you very much for that very important question. Because many times people fall into loan traps, which they call curses, because they didn't make enough preparation. They didn't have those considerations before they went out to seek for the loan. So these are the things which someone should consider, both internally, to them as an individual, an organization, a company, or even a government. Ugandan government has been having loan issues. We've been borrowing, and we're having issues with payment now. For the last 5 years, we've been having problems with loan repayment. So it goes even to the macro level, the preparation, the consideration. So the things one should consider, the first important consideration an individual, organization, or country should make is a plan.
Okay.
You should have a plan for your business, even before planning for the loan facility. When you have a plan for the business, this plan will inform you on where you're going to get the cash inflows for capital injection, or for getting the money you desire to run certain operations, to buy stock, to run certain things. So this plan, this business plan, not even the loan plan, the business plan is going to inform you of the different sources of funding, which may be equity or which may be debt. And you're going to consider the pros and cons of each type of source of funding. Then there are even hybrid sources of funding, which are both equity and loans. And then after considering which type of funding you're going to go for, if you choose a loan, for example, then you can start considering in the plan which type of loan are you going for. Are you going for a loan which is a soft loan? Are you going for a commercial loan? Are you going for a loan from a commercial institution? Are you going for an informal institutional loan? Are you going for a loan from government, for example, from Uganda Development Bank? Are you going for a loan from an international organization like Yield Fund, like United States African Development Fund? Or are you going from such loans? Are you going to seek out even donations? You get me? Then you consider, all that comes from planning. So you should have a business plan, which is going to inform your decision of whether to take a loan or not, and which is going to inform even your decision on which type of loan you're going to take.
And you should have a personal financial plan.
Yeah, if it's not a business, if you're an individual, you should have a personal financial plan. And if you're not even, if you're neither a business, organization, or an individual, and your government or your local government, you should also have a plan. Even the Uganda government should have a plan with the same basis, like I've talked about when it comes to a business, whereby you know what does our country need, where can we get funding, can we go on our knees to the European Union, or can we go to IMF for borrowing, or can we go to China for borrowing? Then we look at what type of money do we need, what type of what political baggage comes with the money we're borrowing. So that's the plan. Yeah, that's the plan you need. Yeah. Then after planning, of course, and you settled for a loan, you need to understand the dynamics of loans. Yeah, the dynamics of loans. The issues to deal with interest, the issues to do with hybrids of loans plus equity, issues to do with collateral, what you're going to stake, the issues to do with loan repayment period, the issues to do with the nature of interest. Is it reduced balance interest or straight line interest rates? You need to know the small print. We call it the small print. Many times you go out to get a loan, I tell you that the interest rate is 2% per month, which is 24% per year, and then they don't mention. There are things they won't mention. The administrative charges, the insurance,
loan processing fees,
mortgaging fees. And then I have a friend recently. I was having a chat with them, and they're in a fix. They wanted to buy some property, and the property they needed an extra 80 million. So this gentleman walks into a bank, and they tell him he's going to get the loan, and he didn't know when they're issuing out the money. He got 69 million instead of 80 million, and the 11 million was all small print charges, which he didn't know. And by the time he was signing on the loan, he couldn't turn it down because whatever I had to procure, it was time bad. It was time sensitive.
There's a feeling of sweetness every time one makes up their mind to go and access the loan. It all looks rosy. It looks sweet until actually it turns out to be the reality. Yeah. I think it's what you're trying to nail down. That the sweetness is not enough. Your need for money is not enough. There's too much you should consider.
Yeah.
And among those is actually what you call the small print monies involved.
Yeah. Those small print monies, or which you should know. For example, when you're mortgaging, recently actually, personally I went out to get a loan, and when I went out to get a loan, I was there are certain small print charges which I already know. Then the loan officer didn't tell me about the other charge. Then I sought out the manager, the loans manager, and this loans manager introduced me to another charge which I didn't know. They told me that I had to, on top of the general loan insurance, I had to insure my collateral at 6% per annum, and that charge was going to be made by me. So I had to even to reconsider the loan because I wasn't ready to pay that extra charge. So sometimes we don't look out for the things. Then the other thing people should put into consideration, or individuals, or organizations, or companies, or even governments, is the return on investment of whatever they are doing, the intended purpose of the loan. So as I said earlier, if I want to buy machinery and put it in my company, or put it in my organization, or put it in my home, I should work out how much this machinery is going to add to my productivity or to my profitability. So if this machinery is going to add to my profitability by 20% in actual value, money value, then I should be getting, that's the return on investment, then I should be getting that 20% every year. Then I should be getting a loan which is way below 20% every year. Yeah. I can't get a loan where I'm going to have a return on investment of 24%, return on investment of 24%, then yet I'm getting a loan of 30% every year, or even 24%. It doesn't make any sense. I'm not making any money. Yeah, I'm just making money for the bank. but I'm toiling for nil.
You're just keeping up with appearances.
Yeah.
But you're actually working,
Yeah.
but
Yeah.
I get
Then the other factor which I even took, I touched it on a bit in our earlier discussion, is the human resource to handle. Do you have the capacity to handle a loan
even as an individual.
as an individual?
You've never all your life managed even 100 million Uganda shillings, and you're out there rushing out because you maybe inherited property worth 1 billion Uganda shillings. So you feel you can take it to the bank as collateral and get 500 million Uganda shillings.
Yeah.
You should never even manage 50 million or 10 million Uganda
You
shillings.
should have the capacity to go out and get a loan of a certain amount. Yeah, as you said, you shouldn't be excited about big monies. Actually, what happens is that many organizations, before they get loans, they train their personnel, the finance controller, the accountant, the cashiers, the people in operations, to be able to handle the value they're going to add into their businesses. So you should seek out financial help from organizations or companies like Bread and Grow Business Home Limited, who can help you out to bring you to par with your ability to handle large monies, to understand the dynamics of handling large monies, to understand the increased controls, financial control systems which you should put in place in your business, in your organization, in your home, before you can handle large monies. Because every level of resources, every level of or magnitude of a resource requires different controls, those system controls, which are going to help protect it and which are going to help increase it in value and
Maximize its output.
Yeah. So you need to have the ability or the aptitude and capacity to handle and manage particular loans. So don't just get excited and go out for a loan when you can't handle it. That's why many times even the loan, the business sense of the loan may be good, but the personnel. So that's why even I said earlier that many businesses, many institutions, especially large banks and large lending institutions which are even national institutions like the United States African Development Fund or the Yield Fund for European Union, when they're lending out money, they do not lend out any money unless they have trained. Actually, part of the money they lend to you is meant to be a fraction supposed to train the people who are going to handle the money so that they have enough capacity to handle that money, so that they don't go into a loss or the proverbial curse of loans.
Two things I learned from this: that a loan is a potential demon. It is only put out by how much you build your financial spirituality. This is what I get from this. How much you build your financial spirituality is what is most important in curbing this demon called a loan. Don't go away, we come back with the most interesting segment of this show: the loan or credit environment in Uganda. Don't go away. It's the Breed and Grow Financial Talk Point. Ila Wilson Mayengo, your host, together with the finance guru, Mr. Francis Rugolowi Kabinui. We're talking loans, debt, and credit. And we are in this segment focusing on the loan or the credit space in Uganda. To start with, I've heard, and I'm yet to prove from you that it's true, that in the Ugandan credit space, we have two players. We have the dollar and the shilling. And that dollar facilities or dollar credit facilities are cheaper than the shilling credit facilities. Question: is it true? If it is, why is it so? And then, would you advise one to go for the dollar, therefore, against the shilling credit facility?
Thank you very much. We have, as you said, we have dollar loans and we have shilling loans, but the dollar loans are not available to every borrower. Yeah, it's mainly for large borrowers.
Okay.
Go for the dollar loans, and the dollar loans in of course commercial banks mainly. You won't find a dollar loan in a microfinance or a SACCO. Then you find even dollar loans are also common with international lending institutions, which loan their money in either dollars or euros or pounds. Yeah, international institutions. For example, if you're getting a loan from United States African-Uganda Fund or the yield fund or for the European Union, you get this loan in dollars or euros, respectively, as the case may be. So these loans are usually at a lower interest rate.
Okay.
Yeah. For example, the most common interest rate for dollar and euro loans is 6% per annum. 6% per annum in Uganda. Yes, I've dealt with clients who borrowed money in dollars at that percentage.
Okay.
Over the years, and then the shilling loan, a related shilling loan will go for a flat rate of 14% or 16% per annum, where the dollar rate was 6%.
Why the big difference?
The big difference, one, is in the risk of fluctuation of our shilling. There is a high risk of inflation of the Ugandan shilling, which is one of the reasons behind our high interest rates. Yeah. So if you charge me an interest rate of 6% per annum, you find that your interest has been eaten up by the inflation. So you are forced to lend me at maybe 12%, so that even after inflation, you have another 6%.
You have a buffer that remains here.
Yeah, because of our high rates of inflation. So that's one reason why Ugandan loans are expensive.
Would you therefore advise that for anyone who seeks to access a big loan facility, whatever big means, I think you'll help us understand what big means in this case, should go for you would advise them to go for a dollar loan rather than a shilling loan?
Many times loans which are in hundreds of millions, someone can be advised to go for a dollar loan, but with caution, because the caution is you're going to borrow money in dollars, but this money is going to be used in the Ugandan space. You're going to buy stock in shillings. You're going to pay your suppliers, your other creditors. You're going to pay the workers in shillings. Unless you're going to buy your stock in dollars and you're going to pay everything in dollars, then you can go for that loan. But there are other considerations you should have when you are getting a dollar loan, because by the time you pay it back, when you're earning, actually many times you're also earning in Ugandan shillings. So you find that the Ugandan shilling, the other effect of inflation,
exchange rates.
Yeah, exchange rates. Yeah, when you're paying back the dollar loan in dollars, because for example, you may get a dollar loan, you may have gotten a dollar loan 5 years ago, payable over a 5-year period, when the dollar was at 3,000, maybe 3,300 or 400, and now you're paying it back. In most of the years when you paid it back, the dollar has been at a rate of
600, range between that.
Yeah. So now imagine that difference of 300 shillings per dollar when you're paying back may eat out the other benefit you had in the better interest rate. So you should consider, you should do a forecast of the inflation. And if you can't do it still, get financial specialists to help you out, to play around with the numbers or forecasting the inflation, Uganda's inflation vis-a-vis your dollar interest rates before you make a decision of going for a dollar or Uganda shilling loan, even for a large loan.
Very interesting. Talking financial forecasting, implication, financial planning and understanding, implication, financial expertise at the end of the day. Decisions about loans and credit so much rotate about one's financial knowledge and ability.
You're right.
I understand that so well from this show or interaction with Mr. Lugolobi. Another very interesting point that I'd like you to bring to light, Mr. Lugolobi, is in the Ugandan credit space. Time previous or time past, and in the near past, there have been several rumors in the press and all over that of the unfair playing ground or the unlevel playing ground in the financial space in Uganda. And usually they attach this to one's political affiliations or ethnic affiliations. And the allegations have always been that there's some dogs or big dogs, as we would call them, who actually have the special privilege of accessing soft loans from Bank of Uganda, of accessing soft loans from Uganda Development Bank, of accessing monies from NSSF. I heard of the rumor sometime in the press. And yet these very people are playing in the same financial space or market space where all of us are playing. What would you comment about that?
Actually, not only in Uganda, but in many developing economies and financial setups, the playing field is politically biased many times. And for the Ugandan sense, there have been rumors, I've also had the rumors, I've read the reports in papers, in newspapers, in the media, about different people, different businesses, because of different attachments they have with the powers that be, they can access money from, for example, they can access money from NSSF. People can go, for example, government puts money in the development bank to help small business, medium businesses to grow at very low interest rates. But then we find that it's the large fish who already grown up to here, who are going out for these loans, meant for the smaller businesses and fish. So then you have cases whereby people not only get loans, soft loans, but they even get grants. Not only loans but grants, where maybe taxpayers' money may be, the rumors have been going around that even taxpayers' money can be granted to individuals. Then there have also been legal shenanigans or acrobatics, whereby someone's connected somewhere goes and buys maybe a prior-owned government facility, piece of land or property, and when they buy that item, the government challenges that purchase. They take it back from this person. This person goes to court, and then the court awards this person costs, and then this person, the costs are even larger than the amount of money this person paid. They are double. This person gets back their money they invested plus over 100% in costs and interest. So these people get such monies as capital and they use it in their businesses. So we have the layman who can access that money. If you're competing, for example, you're dealing the same products with the person who can access such money, you'll be unfairly done. It's very hard to compete with someone in such a business.
Especially when you're going for a commercial loan. For
you, you're going for commercial loan, the other person is getting a grant or a soft loan or such money from different.
How would you advise such a person then?
The person, the layman.
The layman who is against such bad competition, as I would put it.
The layman, many times when you're faced with such competition, you can stratify the market. You can deliver the same product but stratify the market and look at which market can you target different from what the other person is targeting. For example, you can be selling soft drinks or you can be selling food items, but then the other person may be targeting the middle class and the high class. So if for example this person, you can't commit them with such money in that space. So you may go for the lower class. You go for the lower class and target that, so that you're not kicked out of the market.
Or maybe even consider other financing options.
Or you can even diversify. Or you can also consider other financing options. Or you can even consider geographical diversification. This person may be looking at only Uganda, investing only in Uganda, and where this person has political connections and fair political connections. So for you, may consider going to another geography. You may consider going to Tanzania, to Kenya, to South Sudan, where this person is known, so that you do your billing there.
Very interesting. It's actually could be true that the playing field might not be all that quite leveled. But even then, there's so much one can do and survive in the business world or in the business space in Uganda. Mr. Lugulobi, second to last, we've heard of the very big, I would call it a very big let me just leave it at a problem in the Ugandan credit space of the loan sharks, call them money lenders, who have so many gullible crying at their feet over lost property to the money sharks, to the money lenders. Whether or not they are legal, it's you to tell us. And whether or not their practices are legal, it's you to tell us. Whether or not we should actually run to them in any case or whatsoever, it's you to tell us.
Thank you very much. Money lenders, why they're called money sharks, is because of the connotation of sharks is because of their high interest rates and because of the way they get or collect on their debts when you are failing or having problems in paying. And the interest rates sometimes go beyond 5%, 10% per month, or even 20% per month. Yeah. So these money lenders, prior to 2016, they are not well regulated by the law, by the government of Uganda. But after 2016, there was the Microfinance Institution and Money Lenders Act. 2016, which was put into force. And this act sort of tries to protect us or the general public from being from experiencing the various
from being exploited
by the loan sharks. And but the problem is that most individuals don't know that there's even a law protecting them against the excesses of the money lenders. Yeah, this law makes the point that any money lender should be registered. They should be registered. Okay. Yeah, before people would just lend out money and they will ask you to write that you've actually sold them your security. In Tunze, at the amount of money you're borrowing. Yeah. And if you fail to pay, they take that. And this law now forbids that. Okay. Yeah. So if someone makes you sign that, that collateral is null and void before the law. Okay. Yeah. And then of course this person should be registered. And the other aspect which where we need protection, where it's the government now which should come into play. For the 5 years since the act has been in place, the government, the Minister of Finance was given a right by the act to set the maximum interest rate you can charge. But up to now, the Ministry of Finance has not set an interest rate. Okay. Because this interest rate should guard us from those exorbitant rates issued out by money lenders. Yeah. So I think at this point, the law is there, but we call upon the government to help us set a cap for the interest rate. Yeah.
So as of now in Uganda, anyone can set any interest rate they so desire.
Yeah. Until the Minister of Finance or the Ministry comes up with a cap on interest rates. Wow. But then as for collateral, we have some protection when it comes to collateral. Okay. And we have some protection when it comes to documentation and registration of the money lenders. Because now you can't just come, you can't just lend out money on a regular basis to different individuals and charge interest rates.
Regularity and multiplicity.
Yeah, and multiplicity. Because if you lend to me money once, you are not a money lender. Okay. Okay. If you lend to me money today, then I ask you again, you lend me again maybe in December alone. But then if every month you're lending out money to 3 different individuals, then the regularity of lending and multiplicity of
the individuals,
your existing facilities too, makes you a money lender. So in that case, you're supposed to register. If you don't register and you lend money to me, you can even lose your money, which you've lent to me if you fail to pay. Okay. Without me losing the collateral. So by forcing the money lenders to register and by mitigating or stopping them from using unscrupulous contracts, loan contracts, government came in to help out on the issue of money lenders. But then the other thing is that the government maybe should help sensitize the public on this law, so that they go into borrowing money when they're in distress. Many people go into money lenders because they're in distress. They want quick money, they want it like yesterday, and they can't wait for the long process of banks and other financial lending institutions,
Mm-hmm.
or even, yeah. So people, because you'll have those situations and you'll need that money, I wouldn't advise you to get that money, but when you have that situation, sometimes you have nowhere else to run.
Mm-hmm.
But because of that, government should come in and sensitize the populace on the protections and the guarantees
Mm-hmm.
and the rights they have before they take out these monies from loan sharks.
Your Center for Financial Knowledge, reliable Center for Financial Knowledge, Breed and Grow Business Home, is here to tell you that there's a law in Uganda that regulates money lenders, and do not fall prey to the money sharks. Be guided, be knowledgeable, and be in the understanding and guidance of the experts. Mr. Lugolobi, as we close today's show, been quite an interesting one. I would like to close by asking a question. Are loans or credit facilities, depending on your experience and the global or international statistics, are loans and credit facilities such a necessary evil?
Loans are a necessary evil. When I've studied financial growth and development of different businesses, different individuals in Uganda, in the US, in Europe, and most of them in their early years, they've needed loans. The equity many times you have, the equity you can amass from the amount of money you've saved and the amount of money which has been donated to you maybe by friends or relatives or parents, is not enough to start your dream. Many times you can do the first year or the second year, but if you want to go to two notches or 3 or 5 notches higher, you will need more money. Mm-hmm. And many times you're at a stage whereby you can't attract further equity through shares. Mm-hmm. Before you grow to the extent of listing and of an IPO, initial public offering, and you get money from the public, general public, you need money which is going to push you to that stage of growth. And many times you have no option but to use other people's money to make your own money. And using other people's money is going for loans.
And that's the gospel according to Francis.
Use other people's money to make your own money.
Yeah, sure.
I've been there myself. I've seen. I've interacted with clients who are using loans, and I know very many rich individuals, very many companies have gotten to where they are through debt or through acquiring loans. But as we've said, loans are a good thing only if they're thought of, if they're thought out, if they are based on planning, if all considerations are made, if they're based on seeking financial advice, and if projections are put into consideration. But always, when equity fails, always run to a loan after due consideration.
It is the finance gospel according to Francis that use other people's money to build your own money. When Francis preaches that gospel, listen. He's one of the people I know who have built a real estate empire out of credit and loan facilities. When he preaches, listen. Thank you once again for tuning in to the Breed and Grow Financial Talk Point. Your host here, Wilson Mayengo, and with me, the finance guru, Mr. Francis Lugolobi, Cabinet, the Chief Finance Officer, Breed and Grow Business Home. Until next time, every week, catch you around.